Welcome back, everyone. Michael here with Offshore Citizen. The currency markets are in turbulence lately. If you look at a bunch of currencies relative to the US dollar, I've seen some people saying, it's kind of funny that Bitcoin is less volatile than things like the British pound. And so, this is somewhat humorous given normally that the volatility of something like Bitcoin is an issue. Anyway, in the event of the fact that we have all this currency turbulence, I've been talking to some clients who are asking about investing in ways that changes their currency exposure, right? And so, of course, one of the things you can do is you can just hold different currencies. Obviously, right now, it's been the best to hold the US dollar, but if you wanted to diversify in some way, you could pick and choose accordingly. However, the problem with this, obviously, is that your money is not productive there. Now, there's times where certainly holding cash worked out better than holding investments because the investments were all collapsing. But we often want to find ways to make our money productive if we're looking at something long term. And this is especially true if you say, okay, well, in real terms, my money is eroding due to inflation, so I want to do something to counteract the inflation effects. And so today I'm going to talk to you a little bit about the subject of how to think about currency exposure in investing, and therefore what investing decisions to make. So I'm going to share some wisdom that I got originally from Ed Bogle, who is the founder of Vanguard, which is probably the most famous ETF, diversified index fund company. And we will dive in from there. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. Thank you for your support. Thank you for helping us to grow this channel. And if you are interested in help, I am Michael from Offshore Citizen. We help you with custom, holistic, international solutions for your business and yourself personally, helping you to figure out things like global tax, optimizing your tax to pay the lowest legal amount of tax possible, international banking, investing, relocating abroad, getting second citizenships, residencies, etc. If those things are interesting to you, please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below, or you can send a message through offshorecitizen.net. Okay. So let's just kind of look at things from two standpoints, okay? So one is the asset itself that you are buying and the denominations of the asset, okay? The second is thinking in terms of the yield of the asset, and both of these things are, I think, pretty important. So what are we talking about? Let's say, for instance, that you were to go and buy real estate in Portugal. So what have you got? Well, you have euro-denominated real estate, which means fundamentally if you're exposed to the euro, in theory, and the euro is going down, the price of your real estate on the global market is going down, which is kind of a weird thing for people, that something can go up in relative terms or in like the denominated terms, right? So in other words, the value in terms of euros could increase, but the value in terms of dollars could decrease. And so the more wealth you have, the more you should be thinking in terms of global markets and where to position yourself accordingly. I remember this was kind of first articulated to me, this was many years ago, maybe in 2011, maybe a little bit earlier than that, maybe it was 2009, 2010, somewhere in there. And I was at a conference with some people and they made some comment about, oh, the price of gold went down yesterday. And someone was like, what are you talking about? They're like, no, the price of gold went up. And they said, no, the dollar changed in value. And because gold is denominated in dollars, that's how it looked. But on the global stage, it's the opposite. And so this is just like a useful observation for people to have, paying attention to what is the denomination exposure of their assets. Clearly, the most basic one you can do is actually have loans in that currency, right? So I can take US dollars and I can lend you money in US dollars and you can repay me in US dollars, then it's very clear what's happening, right? I can earn some yield on that because I know that I'm getting paid a certain rate of return on the loan. Awesome. But then you get into things that are more difficult to figure out. Real estate is even starting to be one of them. For example, if you're buying real estate in Turkey, you have the Turkish lira, you might say, oh my gosh, the Turkish lira inflated or devalued by 70% last year or something like that. And therefore, Turkish property must have done poorly, right? Well, no, Turkish property is basically priced in US dollars, and so prices actually in Turkey went way, way up last year. It was, from the charts that I saw, the biggest increase out of any market globally. Obviously, you're averaging, so there's specific areas. And largely driven by the fact that you've had a lot of Russians go in there, a lot of Ukrainians, et cetera, following the war, big fueling of their citizenship by investment program, et cetera. So you've had a bunch of this that has been propping up the real estate market in Turkey, in spite of the fact that the Turkish lira has been doing absolutely horrifically. Okay, so you have to kind of pay attention to what is the local denomination, because in some cases it matters, in some cases it doesn't. A counterexample of this would be Malaysia. In Malaysia, property is actually denominated in Malaysian ringgit, and so what you'll see will actually be fluctuating accordingly. Okay, now to some extent there is global, if you have a large global investor pressure coming in on that market, then they may basically be arbitraging it anyway, and that kind of has some mitigating effect, but a lot of markets are not that way. So that's just an important point to understand. Let's talk about the other side of it, which is probably more important, and this is buying companies. Okay, so some people will say, okay, look, like I should buy companies that are based in XYZ country because that's their denomination. So just as a simple example, I could look at Shopify. Shopify is a Canadian company. You can buy it listed on the TSX. You can also buy it listed on the NASDAQ, denominated in US dollars. So you might say, okay, well, look, I'm buying something, this is like Canadian dollar exposure. That's not good, right? But the truth here is what you have to pay attention to is really not where the company is based from the standpoint of currency exposure. And this comes to the Ed Bogle insight that I heard him give quite a while ago. So he was talking about investing in the S&P 500. And some people were asking about, should people be investing in emerging markets, foreign markets, etc. And he said, the reality is you already have exposure to that through the S&P 500. And this was a really interesting insight to me at the time. I hadn't thought of it. But it's like, yeah, who's selling, phones in Thailand? It's not some random Thai company. It's Apple, it's Samsung, it's, the big international cell phone players. Who's selling vehicles in Australia? It's not Australian companies. It's, big Asian companies, big European companies, big American companies. And you can just start running down the list. And so I think what really matters when you're trying to think about currency exposure is understanding the business that you're investing in's costs and revenue structure. So hopefully they're a place that is spending money in a currency that's declining, and they're having customers in a currency that's going up. And then they're able to charge those customers in the local currency. So for example, let's just say I had a company that I had a team located in Malaysia. So I'm paying them in Malaysian ringgit, right? I'm paying my office costs in Malaysian ringgit, et cetera. And at the same time, I'm selling mostly to American customers. All right, well, I'm probably going to denominate the sales in USD. And so I'm bringing in US dollars and I'm spending Malaysian ringgit. You could, if you were an American company, you'd just bring in US dollars, spend US dollars. Here you're getting the arbitrage from the two. And so obviously, this is going to vary company by company. But I think it pays to understand the breakdown. And if you're going to do research on companies, most people don't really spend that much time researching all the little nuances. And so you could be exposed to currency risk because maybe a disproportionate amount of the revenue of a company is based in one particular part of the world, and that part of the world happens to have a currency that's collapsing, right? So in other words, if I'm an American company selling mostly into UK, this is really bad for me right now because the British pound is dropping, right? If on the other hand, I am a British company that is selling into the US, then I'm probably doing well because the US dollar is going up relative to the British pound. But it also would depend on where my expenses are. If I'm hiring salespeople in the US, then that's probably an offset because it's costing me more to pay them, and just as I'm bringing in extra money. So I want to kind of be thinking from this perspective of, if we're going to have global turbulence of currencies, and if you're going to be in an environment with, say, a rising dollar, all right, what are the companies that are most benefiting from a rising dollar due not only to where their customers are, but to where their suppliers are, and are able to arbitrage that accordingly. Obviously, if it's predictable for a long period of time, companies are going to adapt. They're going to find ways to adjust. But it is certainly some sort of a competitive advantage that you can gain one way or another. So those would be the basic kind of thoughts and overviews that I would have. So number one, pay attention to what the denomination of the asset is that you've got. And by this, I don't just mean, okay, I'm buying the Canadian dollar version or the US dollar version. That could be okay. By the way, you shouldn't have any real difference between here. Basically, it should get arbitraged out. So they basically should be the same in currency terms. So the reason that you would do that is if you're a Canadian, you would buy in Canadian dollar terms probably, simply because of the fact that then you're avoiding the exchange rate back and forth. Or if you're already holding US dollars, maybe you want to buy in US dollars. Like I have brokerage accounts in places that it's not the local currency, but I just always have it in US dollars. That's just how I organize my affairs for that purpose. So that's the first thing. The second thing is, to the extent that you can have assets like loans in a currency that are going to do well. I remember, what's his name? Very famous investor, Jim Rogers, had a good opportunity where he'd invested in bonds in Russia. And it turned out the bonds were paying, I think, 9%, but the Russian ruble, which it was denominated in rubles, and the ruble did really well during that time, so he ended up, I don't know, 27% or something, like a quite a much higher return than he would have if it was just purely based on the return of the bond. So that's kind of the next thing. And then the third thing is investing in companies, or it could also be real estate, right? You could be in a situation where maybe you have a rental property, like a vacation rental, and you're renting to a global market of tourists in, let's say, USD, but your expenses are local. That could also be a similar way to get arbitrage. So paying attention to whatever that asset is, whether it's a company or real estate or whatever, what the costs are denominated in, and what the income from your clients are denominated in. So I hope that helps. Let me know if you have any questions, put them in the comments below, and I will look forward to seeing you on the next video.